Okay, so we're going to look at what to do, some of the things that we can do with cost volume profit besides just find the contribution margin. So remember, at the end of Tuesday, we had figured out how to calculate the contribution margin. Do you remember what the contribution margin is? Revenue minus what? I know, I started you out making you think.
Minus variable cost.
Yes, revenue minus variable cost gives us our contribution margin. And then after our contribution margin, for a contribution margin income statement, after our contribution margin, we would then subtract all of the fixed costs to get our total net income. And with the contribution income statement, your net income is still going to be the same as what it would be if you were not using a contribution margin income statement. So like if you could compare the net income on the contribution margin statement with the net income on the statement that you're used to seeing, and it would be the same. Does that make sense? Are we good there?
Yes.
Okay. So now, yes. So now what we're going to do is we're going to take what we know about contribution margin and we're going to use it to analyze some other information. So the first one is called I'm sharing PowerPoint, right? Right? There's
yes.
PowerPoint. Okay, good. The first one is called the margin of safety. And what the margin of safety is you're going to take it's basically what you expect your revenue to be minus break even. Because what the margin of safety is everything that you expect to make over your break even point. So it's kind of like your margin of safety being that, you know, you could theoretically lose that much and you would still break even. So that's what margin of safety means. So the formula for the margin of safety is we're going to take our expected sales dollars minus our break-even sales dollars and divide it by our expected sales dollars. So this gives us a margin of safety of 20%, which means that if we earned $100,000 like we expected to, we could lose up to 20% of that and still break even. You have to calculate the margin of safety on the test. All right, are we good there? See, that wasn't hard, right?
Yes. No.
Okay. Wow, going mouse happy here. Okay, computing sale. Okay, so now we know what break even is. Theoretically, I mean, the basic formula for break even is when your profit equals when your sales dollars equals your variable cost plus your fixed costs, right? It's a little bit more complicated because to get variable costs, we have to take the number of units that we're going to sell times the amount per unit for our variable cost. But break even is when our total costs, our fixed costs plus our variable costs equal whatever we're selling. So if we wanted to, and one of the formulas, if we wanted to figure out how much we have to sell in dollars to break even, then we would take our fixed cost on top, right? And we divide it by our contribution margin per unit. That's how we figure out break even. So if we were looking at this, left my phone downstairs. So if we were looking at this and we wanted to know what break even is, we would take our fixed costs of $24,000 divided by our $30 contribution margin per unit. So we'd have to have 800 units in sales to break even. Now, we can use that same formula to figure out what would happen. Latrice, say hi to him. That's fine. Hey, my kids pop in. My husband does too. They want to know what's going on the computer.
That was my husband, not the
I know that was
kids.
your husband. That's what I'm saying, but my kids pop in more than my husband does, but he's popped in too. They want to know what is so engaging on the computer, right? That's what they want to know. Oh, yay. Oh, I'm so glad. I didn't know. I did my daughter's hair differently. I'm so glad you like it. And I texted to my coach. McKenna competes Saturday. And because we like to do things differently. And so last year, the way we were doing it, our coach liked it so much that for Christmas, she gave everybody the same thing that McKenna uses. Well, and even worse than that, not only did she give them the same thing that McKenna uses, but I bought them because I knew where to get them. So, but I mean, I wasn't going to tell her no. So this year it's like, well, crap, now I have to do something different. Will it stay? No, it's going to fall all over the ice with bobby pins and everything, and it's going to fall down while she's jumping. Test tomorrow. So, yeah, so I had to completely change her hair. Okay, so 800 units is break even. So I could also say, let's say that I wanted to have $12,000 in profit, right? I figured out my break even and I want to have 12,000 in profit. So all I have to do to figure that out is I'm going to take my fixed cost plus whatever additional profit I want to have, and I'm going to divide that by my contribution margin. So here, 800 units would be breaking even, but 1,200 units would be would earn me an additional $12,000 in profit. All right, are we good there?
Yes.
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 See if I can do this. Oh, good. All right, so here's what it looks like if we put it in a contribution margin format. So we have our sales minus our variable cost equals our contribution margin minus our fixed cost gives us our target income. So if we were going to sell 120,000, we can test this out because our variable costs here we had per unit amount, right? So our contribution margin is $30 per unit. Our fixed cost, we would say, is 24,000. That doesn't matter right here. So our contribution margin is $30 per unit. So if our sales, if we sold $120,000 worth of sales, our variable costs are $84,000. Our contribution margin is $36,000, and that leaves us $24,000 to cover fixed costs. So our target income is $12,000. This also means that every single dollar that we make over the $12,000, we keep the contribution margin percent of that as profit. So we can also look at this in a dollar amount. So let's say that we had, we wanted to figure out what would happen if our fixed costs went up. So let's say our fixed costs, you know, were, I forget what they were up here. What were they up here? 24,000. Here they were 24,000. We figured we needed 800 units. Here we're saying, what if they were 30,000 instead? Well, you can just change your fixed cost. You still know your contribution margin, and you can figure out very easily how many dollars you have to sell. So that contribution margin, which we're going to do more and more with in future weeks, is kind of like this magic number. If you know the contribution margin, then you can figure out what happens if, you know, all these little changes take place. It's easy to see the impact on the bottom line. Okay. That's it for contribution margin so far. Although, don't shortchange studying it because it's on the quiz. But even more importantly, we're going to heavily use it next week. So let's look at 19. All right, so chapter 19 is interesting. And there's several questions on the quiz about this. I'm like, why is this so big? Oh, there we go. Oh, that's neat. I can make them really tiny. Always learning something new. All right, what we're going to do now, everything we've done so far in financial accounting and here, everything we've done so far, the bottom line on the financial statements is typically the same, except for inventory costing. It's typically the same. So when we did the variable cost income statement versus our traditional income statement that we're used to, the bottom line, the net income would still be the same. We're going to look at two different ways of combining costs. And the difference between absorption and variable costing has to do with what costs we expense in the period that they're incurred and what costs we go ahead and put into the product. Now remember, the costs that go into the product go on the balance sheet as part of inventory, and the period costs get expensed right away. So let's say that we change the costs that we're putting in as period costs and the costs that we're putting in the inventory. If we take a cost and move it from one category to the other, it's going to change two things. It's going to change our assets because it's going to change the value of the ending inventory. But it's also going to change our income statement because it's going to change the cost of goods sold. So when we're looking at the difference between whether we use absorption costing or variable costing, the bottom line, unless we manufacture and sell all the same number of units, the bottom line will be different. Our net income will actually be different. But it's not hard because all we're doing is all you have to remember is that with one, here's the cost categories, with the other, here's the other ones. And we'll work through several examples and the quiz examples. Okay, so for absorption costing versus variable costing, we have two completely different costing methods that we're using. Variable costing includes direct materials, direct labor, and variable overhead. The way I remember which includes more costs is that absorption costing like absorbs all the costs. That's how I remember it. Absorption costing includes direct materials, direct labor, and both variable and fixed overhead. So our difference is not significant, but our difference is fixed overhead. So basically, variable costing does not include fixed overhead. And absorption costing does include fixed overhead. Doug, Helton has to come out of his room. He has to come out now. Helton, out of your room now. Right, to get a charger so my calculator doesn't die and be yell at my son. Doesn't seem to understand bedtimes. Okay, so the difference is where fixed overhead goes. So when we have fixed overhead, we're going to include it in absorption costing. It'll be part of inventory in our absorption costing. But when we do the variable costing method, fixed overhead is expensed in the period in which it's incurred. So absorption costing is actually the way you're used to doing things for GAAP. Your absorption costing income statement would look exactly like what you're used to. The variable costing income statement will look different. Okay? And why do you think there is a difference? We're required to do absorption. So from a managerial standpoint, from a managerial usefulness standpoint, why do you think we would want to leave fixed costs out of the inventory cost? What would be the benefit? You know what? Crap. I'll be right back. I have to get my cord for my computer. I'm really organized. Figure out the answer to that. I thought I had a cord up here that lives up here, but apparently not. Okay, now, did you figure it out? Why is taking fixed overhead out a benefit for management to use the reports? What kind of expenses are included in fixed overhead? What are some examples? How about rent?
Salaries.
Oh, the management salaries. Depreciation, maintenance on the equipment. Okay, so if you were running a division, are those costs that you have any control over?
No.
No. So if they're not costs that you have any control over, is there a benefit to having them on your report?
No.
No.
See, that's what we're really looking at. It's like we want to try as much as possible to separate the costs that management can control from the costs that they can't. And so that's one of the reasons that for managerial accounting, we use variable costing where we take out that fixed overhead because they don't have any control over it. There's nothing they can do about it. So that's the reason. Okay, so like I said, the actual net income can differ between the two. And the amount of difference is going to depend on how much the difference is between what you produced that period and what you sold. Because, and we'll look at an example that shows this, if you produced exactly what you sold, then the costs are going to work out the same, because if you put them on, whether you put the fixed costs into inventory or not, if you sold all the inventory, they end up on the income statement. Make sense? And if you, so it doesn't matter where you put the cost. If you put the fixed cost as a period cost and expense them, but all the other costs in this inventory got sold and ended up in cost of goods sold, all the costs are still in cost of goods sold, right? So there's only a difference when you produce more or less than you sell. That's the only time that there's a difference between absorption and variable costing. Now, of course, that's most of the time. But still, that's why there's not always a difference. All right, this is a picture of how you can remember what goes into absorption costing and what goes into variable costing. And see, again, the only difference is the fixed overhead. Like, where did my pen go? This is the only difference, is the fixed overhead. Everything else, for absorption costing, all the costs go in. For variable costing, fixed overhead goes straight to the income statement, and everything else goes on the balance sheet. So we have to remember too, oopsie, this goes to the balance sheet as inventory, and this goes to the income statement. All right, so far so good?
Yes.
This is what a summary would look like. So we have like our direct materials. We're going to look at computing unit product cost. So we're going to use this information. So we have direct materials are $4 per unit. Direct labor is $8 per unit. Now we're going to break overhead down into fixed and variable. So because our direct materials are already variable, and direct labor is already variable, right? Because the more products we make, the more labor it requires, the more material. So both of those are already variable costs. That's why overhead is the only one that we have to separate into fixed and variable. So we've got variable overhead is 180, fixed overhead is 600, so total overhead is 780. We expect to produce 60,000 units per year. Now what we're going to do is we're going to look at what the difference is if we account for it using variable costing versus accounting for it using absorption costing. So for variable overhead, we've got the 180. So these are per unit, right? Notice that these are both per unit. Oopsie. But the variable overhead and the fixed overhead are a total dollar amount. So we have to either use total dollar amounts or we have to use per unit. We can't mix the two because you can't mix the two. So here we're going to look at it by unit. So we have to take this 180 and the 600 and we have to convert it to a per unit cost. So now we know that the variable overhead is $3 per unit and the fixed overhead is $10 per unit. So now we've got under absorption costing and variable costing. The only difference is under absorption costing, we're going to put our direct materials, direct labor, and both overheads go into absorption costing. The only difference between the two is that here, for variable costing, we're not going to do anything with fixed overhead. So if we were looking at absorption costing, if we were using absorption costing, which is what we use for GAAP, our cost per unit would be $25. If we were using variable costing, our cost per unit would be $15. So what that means is, under this method, the whole $25 goes to the balance sheet and inventory. Under this method, the $15 goes to the balance sheet and $5 goes to the income statement. Make sense?
Where did you get the $5?
Well,
I'm lost.
yeah, you should be lost because it's $10. Thank
Oh,
you.
okay.
I was looking at the 5 and I'm like, well, oh, wait, I'm still wrong. No, I'm right now. Okay. You know, I took the quiz review and I actually sat down and wrote out every single one tonight because it's Thursday and my head isn't working. Yeah, I'm like, and as I got halfway through it this morning, I'm like, I feel better. My head doesn't hurt. This is great. And as I got halfway through it, I'm like, my head's starting to hurt here again. So yeah, I wrote it all down because of this. Okay, so $15 goes to your balance sheet, $10 goes to your income statement. Now, so that means, if we think about it, this is all in inventory, right? Until we sell it. So two things happen here. One is with variable costing, we record $15 a unit on our balance sheet as inventory. And then when we sell it, our cost of goods sold is $15 because this $10 already got expensed in the period that it was incurred. Whereas with absorption costing, that $25 goes onto the balance sheet, and the whole $25 goes to cost of goods sold when it's sold. Does that make sense? Yes, okay. Okay. So let's look at the differences. So here we have, this is what happens if, remember I said there's only a difference if we produce a different amount than what we sell, because otherwise it all ends up on the income statement anyway, so it doesn't matter. So this is what happens if we produce and sell the same number of units, and you'll see it'll end up the same. So let's say that our sales were 60,000 units at $40 each. And here's our cost of goods sold. This is absorption costing. And remember, absorption costing has both fixed and variable overhead included. So when we look at this, we see here's the $25 we were just looking at, right? So our sales were 60,000 units at $40 each, 2,400,000. Our cost of goods sold, because we sold everything we produced. So our sales were 60,000, our cost of goods sold are 60,000 at $25 each. So our gross margin's 900,000. Then all of our selling and admin expenses. So we get net income of 580,000. Now, that's same number of units produced as what are sold. Now, let's look at it with variable costing. So now we're looking at variable costing. So with variable costing, we only use, on the balance sheet, we put our variable overhead. And on the income statement, we put our fixed overhead. So now we're looking at this, and we sold 60,000 units at 40, so the 2,400,000 stays the same. But for variable expenses, we have our variable production costs at $15. And we're also putting our variable selling and admin here, because we're grouping our variable together, because we use basically the same thing as a contribution margin income statement to do this. So we're using the $15 here. But remember, it doesn't matter the format of the income statement. We still get to this, we're still getting to the same net income the same way. So the difference here isn't, the difference in the bottom line isn't the type of statement, it's how we combine costs. So because it's a contribution margin income statement, we're still going to separate out our variable costs and our fixed costs. But there's not going to be but our fixed overhead's going to go to our income statement. So we've got the $15 here, and then we have our variable selling and admin. Now the variable selling and admin on this type of income statement, we're still included. See, here it is, the $2 under selling and admin expenses. It's still there. Here we just put it here, the $2. Then we are subtracting our fixed overhead and our fixed selling and admin expenses. We're not doing variable. So our net income is $580,000 because equal units produced with equal units sold. But see how the two statements look different? So on an absorption income statement, it's the same format we've always used. On a variable costing income statement, we used a contribution margin statement. Now let's look, so here we've combined them side by side. So the net incomes are the same. Now let's look at what happens if production is different. So here we have our units produced exceed units sold. Units produced exceed units sold. So let's first think about what that means. That means that there's more inventory cost left on the balance sheet because it's not sold. Does that make sense? There's more inventory cost left on the balance sheet if we produce more than we sell. So here's what happens side by side for the two. So this one is absorption costing, the way we're used to it. So we have our sales, same thing, 40,000 times $40. Our cost of goods sold is the $25 a unit because that includes all of both the fixed and variable overhead. And for our net income, we end up with 320,000. Here, we end up with net income of 120,000. And the reason that we end up with income of 120,000 is because when we sold these units, we're only expensing this $15. The other $10 is still on the balance sheet. Tied up in that excess units produced that we didn't sell. So that extra $10 per unit is still sitting on the balance sheet. So our income is lower, right? Our income is lower, but if you looked at the balance sheet and you looked at the balance of inventory, inventory would be higher. So when units produced exceed units sold, then absorption income is greater. Is higher. Are we good here? Without practice. Now we're going to say, let's say that the units produced exceed the units sold. Wait, we just did that. This is just the same thing. Why did they put it in the last? We just did that. Units produced exceed units sold. These are just bigger examples. And this is the comparison. Okay, so now units produced are less than the units sold. So if units produced are less than the units sold, that means that more was moved to cost of goods sold on the income statement. So under absorption costing, which is the way we're used to doing it, our cost of goods sold was $25. So we sold 80,000 units. Our cost of goods sold is 80,000 times $25. Gives us our income of 840,000. This is if we produced 60,000 units and sold 80,000. So now let's look at what happens if we use variable costing instead. So with variable costing, our cost of goods sold is $15 instead of $25. Where's the other 10?
Balance sheet.
Yes, still on the balance sheet. Okay. So now our net income is $1,040,000 as opposed to, I'm lost, as opposed to 840,000. It's this income is higher This income is higher than absorption costing because with absorption costing, that $10 has been expensed. And with variable costing, the $10 is still on the balance sheet. So we're claiming less expense related to the production and the sale. So if the units produced are less, oopsie, if the units produced are less than the units sold, then the income using variable costing will be higher than the income using absorption costing. Okay, and this is a neat little summary. Come under variable, come under absorption. We don't do this. Okay, so here's what I'm going to do now. Please go and pull up the quiz review. And at the expense of looking like a complete idiot, since I've already gotten up twice to get power cords, I am now going to go downstairs to get my, you know, it's better than last term when I really had, I'm now going to go downstairs to get my quiz review. So we'll write it down on here, but I think we're going to do it a little bit differently this time since we have time. So I would make sure you have paper, pencil, and a calculator. I'll be right back. Talk softer. See my pretty sheets? Oh, now I don't need a calculator. I worked all the numbers. Okay, so here is what we're going to do. What do you remember about calculating the overhead rate? Did I lose everybody? Did I lose everybody? Are you back?
Factory overhead, direct labor times predetermined overhead rate.
Yes. Okay, here's what we're going to do. We're going to fill them out together, but we're going to, how many people do we have here? 1, 2, 3, 4. We are going to go into a breakout room. What the heck? How did I do that? I'm like, whoa. And let you work through some of these just one at a time. We're going to do them one at a time. So one person needs to pull this up and take control. I'm going to throw you all into one room so that somebody else can be in control and can be writing. And you can think through because there's only 25 of them and we have plenty of time. And this way we'll learn it better. Okay, please go to your rooms. Go to your room.
That is the most stressful.
Is that stressful?
Trying to be in control.
Oh, okay. I don't mean for it to be stressful.
No. Come on, no, I'm good.
Daniel's a pro.
I know he is, right?
When you lose something, when I can't find something, I start to panic. I'm like, oh
One at
no.
a time. Oh, okay. So Daniel, I'll tell you a funny story. So the very first time I taught actually like lecturing online, it was for another school. I lost, it was the first time I had ever done it, ever. And I lost the audio. I literally typed in the chat pod for an hour and a half. I still can't even believe I got through it.
Oh, that's more.
I mean, it was just like, well, what do I do? It's like,
good recovery.
I know it worked, and I'm thinking, oh my God, I'm so getting fired, but it worked. So I totally get what you mean.
Pretty funny.
I know, right? So, because one of my concerns is now that as we did that, I was thinking that I think Sharon told me that in the breakout rooms it doesn't record, and I need to make sure. So you guys were right, 4,600,000 plus 800,000 divided by 102,000 direct labor hours equals $52.94 per direct labor hours. And the biggest catch with this one was realizing that you have 4 million for indirect labor and 800,000 for factory utilities. Those are both overhead. All right, good job, you guys. Why do I only have Daniel here? Is everybody else here?
Still here.
I'm here.
This is weird.
I'm here.
Oh, there we go. See, I'm learning too. Okay. Number 2. Okay, so number 2. Red Raider Company uses a plant-wide overhead rate. First of all, let's start with what we're going to learn. We want to know how much overhead will be assigned to each unit produced. Okay, that's what we're trying to figure out, how much overhead. Because it's helpful to start with that and think, okay, what do I know about overhead? All right, I know fixed overhead, variable, I know what's in overhead. Okay. Red Raider Company uses a plant-wide overhead rate with direct labor hours as the allocation base. So we know we've got direct labor hours as the allocation base. 600,000 units are expected to be produced, and each unit's going to require 0.95 direct labor hours. We know we have 2 departments, and we know the manufacturing overhead costs, the direct labor hours, and the machine hours. And we want to figure out how much overhead is going to be assigned to each unit. Before we figure out how much overhead will be assigned to each unit, what do we have to figure out?
The rate.
The rate. We have to do. We have to figure out the predetermined overhead rate, right?
Right. So direct labor divided by factory overhead.
No, factory overhead divided by direct labor.
The overhead divided by the labor. So we're going to take Department 1, the 2 different overheads. Is my calculator in the way?
No.
2, 2, 5, 5, 0, 0, 0, 0 plus 9, 3, 0, 0, 0, 0. Right?
Yep.
So we know that this is 3, 4, 8, 0, 0, 0, 0. Okay, so we're going to take 3, 4, 8, 0. And what do I divide it by?
Direct labor hours.
Direct labor hours. So my direct labor hours Anybody want to take over adding up? I'm happy to do it because I don't remember numbers in my head anymore right now.
290,000.
200. Oh, wait, I have it written down. 200. 200. That's what I did.
I remember.
Okay, so, and remember, now this is an estimate, right? And this is an estimate because for our rate, everything is estimated, right? So this gives us an overhead rate of $11.68 per direct labor hour. Are we good there?
Yes.
Okay, now the next thing we want to do is we want to assign it. So we have to assign it to each unit. How many units do we have? Oh wait, we don't know. How much overhead will be assigned to each unit? We don't know how many units we have. But we have to know, we have the $11.68. We have to know the direct labor hours per unit. Do we know that?
0.95.
Mm-hmm. The direct labor hours per unit is 0.95. So 0.95 times $11.68 is $11.10 per unit. So that's our rate, $11.10 per unit. Does that make sense? So first we had to figure out what the overhead rate was, then we had to use it.
How much?
Okay, are we good there? Are we totally good?
Yes.
Yes.
Okay. All right, so now, this one's easy. Now what we want to do is we want to compute the departmental overhead rate for the mixing department, so that's what we're doing, based on direct labor hours. Okay? Do we have to do anything with the baking department?
No.
No.
This doesn't matter right now. And do machine hours matter?
No.
No, machine hours don't matter either. This is all that matters. Okay, so how do we calculate? We want to figure out the overhead rate. So how do we calculate the overhead rate? It's estimated what?
Overhead cost.
Divided by our driver, which in this case is
direct labor hours.
direct labor hours. So we have 550,000 for our estimated overhead. And our estimated direct labor hours is 420,000.
1.31.
Thank you.
Always stay humble.
1.31 per direct labor hour. Probably should have answered that. It was from California. It's probably someone in our class. That's happened before. I've had people, can you answer a question? Yes, just come to class and I'll answer the question. Are we good here?
Yes.
Yes.
You're going to love the next one. Because the next one, we want the departmental overhead rate for the mixing based on machine hours. Does baking mean anything to us?
No.
No. Not, again, it does not. So we want to do our estimated overhead divided by our estimated what?
Machine hours.
So our estimated overhead is 550 still. And our estimated machine hours is 850,000, which equals 65 cents per machine hour.
machine
Good there?
Yes.
Everyone else?
Yes.
You'll like this one too then. Because now what we're going to do is the overhead rate for the baking department for direct labor hours. You should be getting the hang of this by now, right?
Yes.
So what goes on the top?
OH.
Which is in 400,000, right? Divided by, we'll use the 95,000. For direct labor hour. Good there?
Yes.
Yes.
Yes, got it.
One more and we'll take a break. Next one just like this, it's easy too. Now we're doing the overhead rate for the baking department based on, you've got it, machine hours. So by now you should be getting quite used to 400,000 divided by 800,000.
0.5.
Yeah, I was just thinking, gosh, I used a calculator for that. I know, right? Okay, that's the first 6 questions on the test.
Nice.
I know. You comfortable there?
Yes.
All right,
Yes.
let's go take a 10-minute break and come back. Stand up, move around, because otherwise the break doesn't count. 10 after, I'll be right back.
Hey.
Okay, are you guys back?
Yes.
All right, so what we're going to do now is we're going to talk about dividing costs using activity-based costing. So, lovely. So what we want to do is categorize the cost differently. We're looking for what is the activity rate for activity 3. So here's activity 3. So activity 1 and activity 2 don't matter right now. We want to know what's the activity rate. Okay, so the basics still apply. On the top, we're still going to put budgeted overhead, but we're going to do activity 3, budgeted overhead. And then on the bottom, the same rates still apply too, but we're going to put the budgeted activity
Yeah, I did makeup today too.
for A plus B
Yeah.
plus
Oh,
C.
girl, this one lady.
So see, it's basically the same. It's still the overhead cost divided by the activity.
What happened was Inglewood, Beverly Hills made up the case. They put the wrong apartment number. And no,
So what we have here is we're going to take, how much is the budgeted overhead?
106.
106. So we're going to use the 106. And then we're going to add together 3,700 plus 2,200 plus 2,825 for each one of the products we make in that department.
87.25.
What?
87.25.
Thank you. Which is $12.15 is our rate. All right, does that make sense?
Yes.
Yes.
All right, the next one is going to work the same way, but it's going to be more complicated because there's more pieces. So for this one, what we want to do is we want to figure out what is the approximate overhead cost per unit of product A under activity-based costing. So if we're looking at product A, we have to do activity 1, activity 2, and activity 3. That make sense?
Yes.
So it's just good. There's just more to it. So what we're going to do is we'll start out with, let's say we're going to start out with activity 1. We're going to have the 93,000 times the 3,600 units and we're going to divide that. Where did I get the 7,000? God, I asked myself this before. 50.
Product A plus product B.
What?
Budgeted activity, product A plus product B.
Yeah. And so this ends up equaling, I'm going to run out of room if I do it this way. I'm going to have to write smaller. 47,829. On my notes, I had room to go down, but I'm not, so I'm going to put it here. Activity 1. $47,829. Because we're going to want to add them all together. Okay, so then for activity 2, we're going to do the same thing. We're going to say 68,000 times 5,100 divided by the total production, which is 11,200. So it's like this is the portion of A out of 11,200. And that ends up equaling 30,964 is for activity 2. $30,964. And then we're going to do the exact same thing for 3. We'll take 105,000 times the 3,100 units divided by, if we add these together, we get 8,950. Which equals 36,369. So what we have now is the total production for A. The total production cost for A is 115,162. But we're not done, because what are we asked for?
Oops.
Oh,
We're asked for the cost per unit. We have the total cost. So now we have to take that and divide it by our number of units. 36,000 units. We found the total cost, but not per unit. So it's actually $3.20 per unit. So you have to figure out the total cost for A, for activity 1, activity 2, and activity 3 for product A. Add them together. That gives you your total cost for manufacturing product A. And then you're going to divide it by the number of units you've produced to get a per unit cost. So product A, it's our estimate that it costs us $3.20 per unit in overhead. It's one of the hardest ones. Can you do this?
Yeah, there's a lot of layers in that one, but
There's a lot of layers in that one because you're doing all 3 activities.
right.
It's absolutely one of the hardest ones. I don't, if there's any other one even similar to that, there's only one other one. I think that is the hardest one. A lot of layers. Can you replicate this?
I think so.
Yes.
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 Okay, this one's easier. This one, we're just figuring out, we've done this before, the contribution margin. So you think about, what do you know about the contribution margin? How do you get the contribution margin? What's the formula for the contribution margin?
Oh,
Revenue minus variable
Yep.
cost.
Sales minus variable cost. So our sale, we expect to sell 23,000 units at $11 per unit. So our sales are 23,000 units times $11 a unit, which equals $253,000. That's our sales.
Hmm.
Now we have to subtract our variable costs. Variable cost per unit is $5.50. Do fixed costs matter?
No.
No. So our variable costs are 23,000 units times $5.50. So our variable cost, which we're going to subtract, is $126,500. Which means our contribution margin is oddly, $126,500. This is why I don't change numbers. I can't tell you how many times weird things like this happens to me. This is a coincidence. Okay? Complete coincidence. Oh, I guess I should have recognized that when the variable costs are $5.50 and the selling price is $11. All right, can you do this? All this is calculating contribution margin.
Yes.
Okay, we're going to get a little bit more complicated. This is probably the second hardest one. Okay, so we want to figure out what amount should have been reported as variable cost. So we want to know how much are the variable costs. So what you have to think about here is, well, what do I know about variable cost? I know that my sales minus my variable costs minus my fixed costs equals my net income. Does that make sense? Because
Yeah.
basically this is sales minus all of my costs, so it equals my net income. Now, here we're referring to it as pre-tax income. That's fine. Same thing. So now I have to figure out what my sales are. All right, so during its most recent fiscal year, we sold 340,000 electric screwdrivers at $22 each. So sales is going to be 340,000 electric screwdrivers times $22. Make sense?
Yeah.
Minus, we're looking for my variable cost. We don't have variable cost. Minus fixed costs. Each fixed cost amounted to $1,500,000. So minus $1,500,000 equals my pre-tax income of $1,900,000. So I have all the numbers here now. So now I just have to work them. So I'm going to take my sales. So 340,000 times $22 ends up being 5,980,000 minus my variable costs minus my fixed costs. Now we're just going to do basic math. Notice how I avoided the word algebra. So how do we get variable cost all by itself? First, I can combine this and this, right?
So sales
Wait, I screwed up something.
Sales minus.
Wait, I screwed up something. Hold on, I wrote down the wrong number. I screwed up something.
Should be 7,
Yeah. Let's look at mine.
480.
Yep. So if I first take these two, then I have my 5,980,000 minus my variable cost equals my 1,900,000. Now, I need to get variable cost on one side of the equation.
5,980,000.
Subtract. Oh, sorry.
No, keep going, both of you.
5,980,000 minus 1,900,000 equals variable cost.
Yep. It has more numbers than any other one. It's not hard. It's just systematic. It's just one equation. I mean, it's all this one equation, right?
Yes.
All right. Can you do that?
Yep.
Yes.
All right. Now we're going to use some information that we already know to make a different decision. So what we want now, we know that management anticipates fixed cost of 80,000 and variable cost equal to 35% of sales. We want to know what will be our pre-tax income if sales are $350,000. So it's still the same formula. Sales minus variable costs minus fixed costs equals income. It's the same formula. So how much are my sales?
350,000.
350,000. How much are my variable costs?
122,500.
Right, which I get by taking 350,000 times 0.35, right?
Yes.
Minus how much are my fixed costs?
80,000.
80,000. So exactly, this ends up being 350,000 minus 122,500. Why did I put plus 80,000? Because I guess I can't even copy down correctly. 147,500. Same formula. You just have to work with the percentage this time. And remember, just in case you don't remember, 35% equals 0.35. Remember, you take that and you move it over to? Remember that rule from way back when?
Yes.
Right? You have to be able to convert percentages. Oh, next one, margin of safety. Margin of safety is not hard. So the first thing that we have to do is we have to figure out the contribution margin ratio. So the contribution margin ratio, remember if we had it like, the formula for it is sales minus variable costs divided by sales. But if you were looking at the contribution margin income statement, you have your sales, right? Minus your variable cost gives you your contribution margin. So the ratio is the contribution margin divided by sales is the ratio, is how you get the ratio. So see how sales minus variable cost is the same thing. We just don't know the contribution margin yet, so I'm expressing it in the formula sales minus variable cost. But see how that's the same as what you already know?
Yes.
So we're going to say sales minus variable cost. So here we're going to do our sales are $520,000 minus our variable costs are $182,000 divided by our sales is $520,000, and that equals 1.35 or 135%. So that's the first step. The second step, because we're asked for the margin of safety, the second step,
I think you did that wrong. It should be less than 100%, 65%.
you know, I wondered, the number seemed wrong when I did it earlier.
Because you're taking less than sales and then dividing by it, so
5.2.
less than 100% anyway.
No.
Right?
Oh, you're right, I added it.
So
That's
it should
what
be
the problem
65%.
was. Yeah, you're. I was wondering. It's when I did it, I'm like, this feels wrong, and I added it up 2 or 3 times exactly the same, and I'm like, no, it's right. $520,000. I have it twice. Who wants to add it up? Because I'm obviously not a good person to do it.
65%.
Thank you. Oh, you just said that, didn't you? Thank you. All right, so now we're going to take our break-even sales, which is our fixed cost, divided by our contribution margin ratio. This is where I said all these, this is one of those, this is the only chapter where it's like the formulas become very important. So my fixed costs is $212,290 divided by my contribution margin ratio, which is 0.65, equals a completely different number than what I have written down using the wrong information. And since I shouldn't be trusted to even think, okay, I come up with 137,989.
I'm sorry. Now, can I stop you for a second?
Yep.
So I think I'm a little bit confused about contribution margin and the ratio.
Okay.
So the ratio is the CM divided by the sales?
Right. Because, okay, so let's say that we were doing this, which is why I put it up here. So let's say that we were doing this, I'm just going to rope this off as an example. Okay, so this is ancillary, all right? So like, let's say that we had sales of $20 a unit. And our variable cost was $5 a unit. Our contribution margin is $15 a unit. Right?
Okay, I got it. That's where I was confused. Understood.
Okay. So then our ratio is 15 divided by 20.
Got it. Okay, thank you.
Professor, your math's off again. Break-even sales should be more than fixed costs because you're dividing by 0.65.
I told you I shouldn't be trusted with the calculator.
So it's 326,600.
Thank you. I even, this is why, okay, I'm telling you, I knew I couldn't trust myself. This is why I wrote it all down ahead of time tonight. And halfway through, I'm like, okay, my head's hurting again. What should the number be? Wait, till I have a pen.
Sorry.
Okay, 326,600.
600.
Thank you. So this looks complicated, but what the margin of safety really is the sales amount minus your break even is the margin of safety. It sounds like this really complicated thing, but all it really tells you is if my break even was $100,000 in sales and I sold $150,000 in sales, then my margin of safety is 50,000 because I could go down 50,000 and still break even. That's all margin of safety means. Okay. Let's see if I can do the math on this one, shall we? All right, this one has a lot of numbers too. It's the last one that does. We want to know the budgeted income statement presented below is for Burkett Corporation for the coming fiscal year. We want to compute the number of units that must be sold for a target pre-tax income of $102,600. So remember, it's going to be the break-even formula basically, but we're going to add $102,600 to the fixed cost. Now, the first thing that gets complicated here is we have to know, is direct materials a variable cost or a fixed cost?
Variable.
Variable. What about direct labor?
Variable.
Variable. Fixed factory overhead?
Fixed.
Fixed.
Yeah. Variable factory overhead.
Variable.
Fixed marketing costs?
Fixed.
And variable marketing costs?
Variable.
Okay, because we're going to need that. So now what we're going to do is we're going to say, okay, we need to know the contribution margin because we use a contribution margin for everything. So we need to know the contribution margin. So we know that revenue minus variable cost is our contribution margin. That's why I had us add up the variable cost, right?
Mm-hmm.
So our variable cost is this, and this, and this, and this. So our revenue is this. So our revenue is $1 million minus our variable cost, which if I added them up correctly is $732,000. So our contribution margin equals $268,000. So now we know our contribution margin. Are we good there?
Yes.
Okay, we want to figure out our contribution margin per unit. So we're going to say, all right, here's our contribution margin divided by the number of units. So our contribution margin is 268,000, and our number of units that we sold is 40,000 units. So our contribution margin per unit is $6.70. All right, now we can start looking at how to figure in this 102,600 that we want extra. So we're going to take to figure out our budgeted unit in sales. We're going to take our total fixed costs plus whatever our target income is, because that's what we're going to add on. And we're going to divide that by our contribution margin per unit. It looks more complicated here, but it's what we just did in our lecture. So our total fixed cost is 260 total fixed cost. Oh, I added those together. So the 104 plus the 110 plus our targeted income gives us 214,500 is the total amount that we want to end up with. That's our fixed cost plus what the profit is. At $6.70 per unit contribution margin, we have to,
Mixed up.
what?
Isn't it 215,400? Or am I looking at that wrong?
It should be, it should be 104,500 plus 110,900 is 300.
No, you have a 178.
I see that. 104,500 plus 110,900 plus the part we want to cut. Oh, God. Plus the part we want to add, which was 102,600. Yeah, you're right. 102,600. 318,000. What am I missing? I'm not missing anything, right? My numbers were just wrong.
Yes.
318,000. Now I just have to remember that for a minute. Quite a challenge.
Where did the 102,000 come from again?
I was just going to write that down. So I'm going to write this up here. So the 318,000 is the fixed costs, which is the 104,500 plus the 110,900 plus the target income, which is the 102,600. So what we have is, we have to, from our contribution margin, we have to meet all of our fixed costs. If we want to meet, so now we're saying, okay, not only do we want to meet, we know what our break even is, and we know what our contribution margin is. In addition to that, we want to end up with $102,600 we can keep in our pocket. In order to end up with $102,600 to keep in our pocket, our contribution margin has to cover all of our fixed costs plus that additional amount. So we're going to take the 318,000 divided by the 6. Where did my calculator go? Where did my lecture go? Where did my calculator go? Okay, I give up. Okay. We're going to take 318,000 divided by $6.70. So
47,463.
thank you. 463. Thank you. And thank you for rounding correctly. Units. So remember, when you go back and you look at the break-even formula, if you're doing the contribution margin ratio, then you get units. If you're doing the contribution margin in dollars, then you get the dollar of sales. So what this just told me here is I wanted to know how many units have to be sold. Now, I could do the same thing with how many dollars I have to sell, like what do my sales dollars have to be in order to end up with 102,600 in my pocket. And then instead of dividing by the contribution margin ratio, I would divide by the contribution margin in dollars. And that gives me dollars. So that's the biggest issue with the formula in this chapter, is recognizing when to use the contribution margin ratio and when to use the contribution margin in dollars. And we're going to practice that right here. So here we want to know break even in sales dollars. Break even in sales dollars. So for this, we're going to say, I had it backwards. We're going to say the fixed costs divided by the contribution margin ratio, which they give us. So how much are my fixed costs?
Total fixed costs 90,600.
Right, my 90,600. And what's my contribution margin ratio?
0.30.
0.30, right. So that equals $302,000. So you have to sell $302,000 in sales to do what? What happens to break even? If I sell $302,000 in sales, I'm going to break even. Now we're going to let's do the break even in units. So now we're going to do the break even in units. We still have the same information. So now we're going to say, we're going to take our fixed costs still divided by our contribution margin per unit. So our fixed costs sells a single product for $700 per unit. Variable costs are $400. Do our variable costs even matter? No, they're not in here at all, because they are in here. But where are they in this formula? You don't need them because you already had them. Because we're going to use that for our contribution margin per unit. So our fixed costs are 900,000. So what's the formula for the contribution margin per unit?
Unit selling total, unit variable costs.
Mm-hmm. So my sales minus my variable cost gives me my contribution margin per unit, right? Yes?
Yes.
I know you're getting tired. 3,082 units. So I have to sell 3,082 units to break even. So units use my contribution margin per unit. Dollars use my contribution margin ratio. For units, you want units. For dollars, you want the ratio. And honestly, if you did it and you did it this way and you were trying to get dollars, you'd look at this and you'd say, well, wait a minute, this can't be right because my fixed costs are $900,000 I obviously can't break even by selling $3,000, right?
Right.
So if you look at the answer after you're done and ask yourself, does that look like it could be the answer? Then that's helpful as well. Okay, now we're going to get into, we're going to revise a contribution margin, but this isn't hard. Because all we're doing here with the revised contribution margin ratio is, you know, the formula. Sales minus variable costs equals the contribution margin. So we have old, which we're not going to do a lot with, and we have revised, new. Considering buying new equipment that would increase monthly fixed costs from 420 to 522. Does fixed costs have anything to do with the contribution margin?
No.
No. All we're worried about is variable costs. And would decrease the current variable cost of $80 by 20. So our old one, our old variable cost was $80, and our new one's going to be what? It's going to decrease the current variable cost of $80 by $20 per unit.
60.
60. The new one's 60. Right. It decreased it by $20 per unit. Break-even sales. The selling price of $120 is not expected to change. So the selling price is $120 here. We're only worried about per unit. And here, it's still 120. So our new contribution margin is going to be $60. But we want the contribution margin ratio. So the contribution margin ratio is the $60 divided by what?
120.
120.
20. Yep. Which equals 50%. So it's the same thing, you just have to read. Are we good there?
Yes.
Okay, now we want to figure out what will be net income. We know the break-even point is $1,300. We know the sales price is $17. We know the variable cost is $13. If the company sells 3,100 units, what will net income be? Okay, well, we know that net income equals,
I'm sorry, Catherine. Your picture is, I can't see. Sorry.
does that work?
No, your the video part of you is on your slide, so I can't see all the information.
That's weird, I haven't changed anything. Does that fix it?
Yeah. Thank
Okay.
you.
Thank you. Okay, that's really interesting because I can't see that. It doesn't show that way to me. Okay, net income, thank you, equals contribution margin times the units sold that exceed break even. So my net income, I'm selling my contribution margin is, I have sales price is $17 and variable cost is 13. So my contribution margin is 17 minus 13 times the number of units sold that exceed break even. So break even is 1,300 and we want to sell 3,100. So my contribution margin is $4. And the difference in sales is $18, $1,800. So let's talk about what really just happened here. If I had done this where I did a contribution margin income statement and I said, okay, my contribution margin is $4, right? After fixed costs are satisfied, all I really have to know is my contribution margin times the additional units. That's all I have to know. Because at break even, my fixed costs have been paid. Does that make sense? At break even, I've already satisfied all of my fixed costs, right? So one of the benefits of contribution margin is that for every additional unit after I've paid my fixed costs, which is break even, for every additional unit, my profit is going to be whatever my contribution margin is per unit. So after break even, every additional unit I can multiply by my profit margin.
Can you go back to question 16, just 2 seconds?
This one?
Okay, you're good. I just missed one of the numbers. You can go on.
Okay. So I want to ask you guys something. Do you want, we have 18, 19, 20. We have 7 more questions. 8 more questions. 7 more questions, my God. We have 7 more questions. Do you want to finish them now or do you want to do them tomorrow night?
I'd prefer now.
Okay. All right, question 18. What we want to do, now we're going to do absorption and variable costing. So we want to know what is the value of ending inventory under absorption costing. Remember, absorption costing has everything. So for absorption costing, we're going to have, we are going to include the fixed overhead, right? Because absorption costing includes everything. So we want to know what's our ending inventory. So we know during the first year of operations, the McCormick Company incurred the following manufacturing costs. Direct materials are $8. We're going to include those, right? Direct labor is $6. Variable overhead is $5. And fixed overhead is $350,000. We know that the company produced 40,000 units and sold 32,000, leaving 8,000 units in inventory. Okay, so the first thing we have to do is we have to, all of these are in unit costs. So we have to make fixed overhead in unit costs. So for that, we're going to divide it by the number of units that we produced because the overhead was incurred during production. So what's 350,000 divided by 40?
$87.50.
Thank you, because I'm dealing with my phone now. $87.50 is our fixed overhead per unit.
I know. I think it was 8,750.
Oh yeah, that makes sense. $8,000. $8,750.
Should be 8.75.
Yes, it is 8.75. Yes. I was doing by 40. My mistake.
Hey, at least it's not, totally understandable. I'm not going to criticize. What was the number again? $8.
8.75. Yeah.
45?
75.
75. Okay. Okay. So now what we're going to do is, so we want to know ending inventory under absorption costing. Okay. So what you want to think about is under absorption costing, everything gets included in inventory. Nothing gets expensed in the point of sale. So we have $8 plus $6 plus $5 plus $8.75 times the number of units in ending inventory.
Then I asked you to come up. Now.
Hey, I'm glad I'm not the only one that yells at my kids.
Ooh, somebody's in trouble.
So there's something wrong with my numbers here too. So 8 plus 6 plus 5 plus 8.75 is $27.75 times the 8,000 units still in ending inventory. Equals 70,019.
What is the 8.75
That's the factory overhead per unit.
per unit?
Because factory overhead was given to us in total. So we have to take it by unit. And so we're going to take the factory overhead they gave us. We were given that factory overhead was $350,000 for fixed overhead. And so we're going to do that by the number of units produced.
Mm-hmm.
That's the dollar amount times the units, correct?
What's the dollar amount times the units?
The direct material, direct labor, all the overhead,
Yes.
variable and fixed.
Yeah, we took each one of the costs times the units in ending inventory.
I got a different number.
I did too when I worked it out.
222,000.
Yeah, I did too when I worked it out. So I wondered what I did wrong here. I just figured it was that I did this wrong. Because I didn't work it out like that, I put it all in one formula. Okay, 350,000 divided by 40,000. We're sure it's $8.75.
Yes.
What's 8 plus 6 plus 5 plus 8.75?
It's the 2775.
Okay, so what's that times 8,000?
222,000.
No, take those off. You come over here to say.
There's my calculator.
You can make them up.
Come here, guys.
What the heck?
Hey,
There.
what is happening?
Good night.
Good night. Roxanne,
So what is happening?
it's Mimi's time. Say good night, please.
Could you tell me what that number is, please?
222,000.
2,000, that's better.
Good night, my dear.
Okay, so with absorption costing, there are two things we had to do here. One is you have to know that you include direct materials, direct labor, variable overhead, and factory overhead. The next thing that you have to know that you have to do is you have to take the factory overhead and convert it to a per unit. And you have to make sure that you do that based on the units produced, because you have all of these different numbers of units, and it's the units produced that matter in the factory overhead, because that's how we incurred overhead. Then you just simply add them all together, and because you're looking for ending inventory, you want to multiply the entire cost by the ending inventory. So those are the things that you have to be careful of. Okay, so for 19, now we want to figure out the contribution margin for this month if we sold 1,200 units. So this isn't hard because we know that contribution margin is sales minus variable costs, right? That you should be feeling pretty good about.
Right.
So the question is here's my sales. Is direct materials variable or fixed?
Variable.
Variable. Direct labor variable or fixed?
Variable.
Variable. And variable overhead we'll say is variable. And this is obviously fixed, so it doesn't count. So we have our sales price. Unbelievable. Okay, so we have sales. If 1,200 units were sold, so our sales price, so we have 1,200 units times $42 each, which equals 1,200 times 42, 50,400. And then minus our variable costs, which is 9 plus 6 plus 8, 9, 18, 23. Yes?
Yes. Eight
1,200 times 23, 27,006. Was that 27,600? Yes, okay. So my contribution margin then is 50,400. Really?
600.
27,600. Thank you. 22,800.
100. Yes.
All right. Does that make sense?
Yes.
Now we're going to change that one up just a little bit. And we're going to say, what is the net income under absorption costing? So under absorption costing, do I include the fixed overhead?
Yes.
Yes. If 1,200 units are sold and my operating expenses are 17,000. Okay, so I'm going to say, now I'm not trusting what's written down anymore. 8, 19, 11, 12, 13, 14. Oh, I know why. Okay, so my sales price, net income under absorption costing. So my sales price is 3,700 units times $42 a unit, which equals 3,700 times 42.
We're not using the 1,200 units.
Oh, crap. Yeah, because that's produced. I need to go to bed.
Could we use the last problem just in subtracting the fixed overhead from the last problem?
Yeah, we can. 65. Yeah, we can. I think the date is 3,742. Yeah, it is. So Here we calculated the contribution margin. So the sales were 50,400. Me too. Less so we actually have, we could take this 8 plus 6 plus 9, which we did over here, right? Is 27,600. So I'll do them separately. So the variable costs are 27,600. And the fixed costs are 7,400. And operating expenses are 17,000. Anybody want to add that up? Lost my calculator again. Should come up with what I had here.
$102,400.
No.
Oh, I can't add. Sorry.
Negative 1,600.
Negative 1,600.
Negative 1,600, right?
Oh, I'm sorry. This is subtracting. I thought you said, okay, never mind. Don't listen to me.
Okay. It's a negative amount, right?
Yes.
Negative how much?
1,600.
Thank you. Okay. Net income. And now we're going to do
That's 3,700 units times $42 gives us 50,400. Is that right? Understand that right?
Yeah, we just took it from the previous slide.
Got it.
No, this is sales. That's 1,200 units. We just took it from that one.
It's 1,200 units, right? Gotcha.
Yeah.
Okay, thank you.
We just took it, same with the variable cost, because the numbers are all the same. We just took it from the previous data.
Yes.
Okay, now we have net income. Now we're going to do variable costing. So remember, variable costing does not include the fixed overhead. Right? Does not include the fixed overhead.
Right.
Yes.
Okay, so now we can say we sold 1,200, still have operating expenses of 1,600. So sales. Oh, you know what though? That's for ending inventory. Under variable costing, think. Under the easiest way to do this is to take our contribution margin, which we know.
This is confusing.
Okay, I'll do it the other way.
I'm sorry. Did you hear that?
Yeah, no, I want it. Okay, there's nothing wrong with saying this is confusing. I told you I was getting a headache when I started doing this. This is rough for me tonight. Okay, so net income. So we have sales of, we sold 1,200 units times $42 per unit, which should be the same as what we just figured before. 1,200 times 42.
50,400.
Yeah, 50,400 is our sales. if we produce 3,700 units and we sold 1,200 units. So for these 1,200 units, okay, so for variable costing, because we don't take everything, we need to know what our variable cost per unit is. So our variable cost per unit is the 8 plus the 6 plus the 9. 9 is our variable cost per unit because we don't include the fixed. 9 plus 8 plus 6. See, I don't trust myself at all. Well, apparently. Is your teacher throwing a fit? 9 plus 8 plus
23.
6. Something has to work.
23.
Thank you. So our cost under variable costing is the 8 plus the 6 plus the 9 times 1,200 units. Oh God, I just added those up.
24.
And then 28 plus 8. Really? Really? Somebody add up 8 plus 6 plus 9 and multiply it by 1,200.
23.
27,600.
And then we're still going to subtract the operating expenses of 16,000. What do I end up with now?
11,600.
Now, I would expect my variable costing income statement, I would expect it to be higher net income than absorption costing. Because under variable costing, whatever is included per unit in this fixed overhead, where is that still? It's still on the
Balance sheet?
balance sheet. It's still on the balance sheet in inventory that hasn't been sold. So I would expect my income statement for variable costing to be higher.
I'm
Okay.
sorry. I did not get 11,000. Maybe I don't know how to do math, but the 50,000 minus those other things, we subtract the 27,600 and the 16,000.
400 minus 27,600 minus
6,800.
1600 equals.
Yeah, I got 6,800.
Come on, you guys. If you're going to add up for me, you have to do it right. Wait, don't forget that number because I already forgot it.
Oh, it's 6,800.
800. It's dangerous for me to be doing it this late. 6,800. Still higher. Okay. Question.
Good.
22. All right, income under absorption costing. We're going to take our income from variable costing equals my factory overhead, because that's still in ending inventory, minus my factory overhead in beginning inventory, because they're giving us different information. Here we know that Jetter Corporation had net income of $230,000 based on variable costing. We knew that the beginning and ending inventories were $7,500 and $1,300. the fixed overhead per unit was $4. Okay, so now what we're going to do is we're going to figure out if what would it be? We know that it's 230,000 based on variable costing. What would it be under absorption costing? So the difference is that under absorption costing, that $4 per unit would have been expensed when the units were sold. Before that, it would have been held in inventory. So what we're dealing with now is what's the difference between the fixed overhead, because that's the only difference, the $4, that's in ending inventory versus the fixed overhead that was in beginning inventory. So now I can take, okay, my 230,000 in net income, because I want to know what's my net income. So I'm going to say I'm starting out with 230,000 in net income. That's what I started with. And I need to know what the difference is between the factory overhead that was in ending inventory versus the factory overhead that was in beginning inventory. So I'm going to say I had 13,000 units in ending inventory, right? Times, I'm only concerned with the $4. Minus, I had in beginning inventory, 7,500 in beginning inventory times the $4. So I started out with 230,000 in net income. That $4 made up 52,000 in my beginning inventory and 3,000 in my ending inventory. So if I had used absorption costing instead of variable costing, my net income would have been 194,800 instead of 230,000. So I'm just accounting for the $4 that's in the $4 difference between what was in beginning and ending inventory.
Wait. Do you add the 52 to the 230? Or you
Yes, because I'm saying, okay, this was our original amount. This is what's left in ending inventory. Okay? And this was what was in beginning inventory. Because the $4 in absorption cost, so under absorption costing, all of those units in under absorption costing, all of those units had the cost held on the balance sheet and didn't get moved to cost of goods sold until they were sold. So I'm saying, okay, the $4 per unit counts for what's in ending inventory, but not for what's in beginning inventory. So I'm going to take my net income, add what was left in ending inventory, and subtract what was in beginning inventory.
So I think we should end with a different number then.
No, we shouldn't.
We shouldn't?
Well, maybe, but I don't think so.
I got a different number too.
You gotta be kidding me. 230
Latrice, did you get 148,000?
plus
No.
52,000 minus
30.
Oh, because I wrote the number down wrong. That's why.
Yeah, so it's 252, right?
Yeah, because I wrote down.
Okay, I got it now. Thank you.
God, I gotta go to bed. This is seriously not working. 30 minus 52. No.
No? Wrong?
30 plus 52 minus 30 No, that's right. Remind me to throw these sheets of paper away so I don't use them next class. 24. Easier. Okay, for 24, we just want to calculate, this is nice and straightforward, cost per unit under absorption. So under absorption, we include fixed overhead, but we want to know cost per unit. So we know our direct labor is $8 per unit. Our direct materials is $2 per unit. We're given total variable overhead and total fixed overhead. So, and we expected units produced 41,000. So we have to take the 21,000 divided by the 41,000 to get the per unit amount. I actually didn't write this down separately, but I'll probably do it wrong. 21,000 divided by 41,000 is 0.5. 0.51. And then for fixed overhead, it's still 91,000 divided by the 41,000 units to get a per unit amount. So 91,000. Why does my calculator not want to work? 91,000 divided by 41,000 is $2.22. So this is $2.22. So now we know that for absorption costing, we're going to include all of it. So it's going to be 8 plus 2 plus 0.51 plus 2.22. Did you get, yeah, wow. When I wrote this down on my notes, I wrote down $22.22 instead of $2.22. Wow. So we'll need to add that up. I'm not doing as well as I think I am. I think I need to go to a concussion clinic. 8 plus 2 plus 0.51 plus 2.22. $12.73 per unit under absorption costing. If you were asked to do the same thing under variable costing, what would you leave out? Which is what we're
Fixed overhead.
right, which is what we're just about to do. So now we're going to do variable costing. And for variable costing, we don't have to worry about fixed overhead. Do we do variable overhead?
Yes.
Yes. So this is easy. 54 plus 47 plus 36 is 137. I was looking at it. Does that look like the right number? Per unit. Do you agree? Oh, good. The next one's easy. Okay, so are you getting the difference between variable and absorption? Because I know we haven't worked with it much.
Yes.
Having only introduced it an hour ago. Okay, last one. Thank you for hanging in there. Okay, so we want to figure out the net operating income under absorption costing. So the first thing we're going to do is we're going to say, okay, our fixed and our variable, we want to do sales minus cost of goods sold gives us the gross margin minus selling general and administrative expenses gives us net income. So our sales is $995,000. our cost of goods sold, we're going to add up these two, which when I did it, I got 388,000, which seems like a good number because these are both cost of goods sold. So my cost of goods sold is 388,000, which gives me a gross margin of 607. Sounds right again. I'm going to add these together for selling, general, and admin, which is 263,000. So my net income should be 344,000. That's the last one. Okay, are you all good? I mean, I'm apparently not.
Yeah, it'll just take some practice.
Right. Well, half of it we haven't done before. Half of it we just introduced. But if you think back to the first half, it wasn't as hard, right?
Right.
Right. So, I mean, it just takes some practice, but that's what we have practice problems for. Okay. Call me if you have questions. I'll post the one with notes right now in the announcements, and I'll post the video in the morning.
Sounds good.
Okay?
Thank you.
Oh, one weird thing. Saturday, my daughter has a skating competition in Lansing. So from like 11 o'clock my time until like 4 o'clock my time. So 8 to 1 o'clock for most of you guys. So a good chunk of like the first half of Saturday, I'm kind of out of pocket. You can text me if you have a question, and I'll be glad to text you back or call you if I can. There's a lot of waiting and everything too in between events, but texting me is the best way to reach me on Saturday until late afternoon. Okay?
Sounds good.
All right. I will see you guys on Tuesday. Call me if you have questions.
Thank you.
Post this. Good night, you guys. Thanks for
Good night.
hanging in there.